Did you know that the $6.30 silver price is a trap? The refineries are halted, wholesalers canceled orders, and the paper price no longer reflects reality. Physical silver is disappearing fast, and only those who act strategically can preserve wealth. In this video, I'll show you exactly how the market has entered the unobtainium phase, and why waiting even a day could leave you empty-handed. Yesterday, you might have thought you were safe. Today, you realize the game has changed. The price is $6.30, but supply has vanished. Dealers are hoarding what they have. Refineries have frozen. Wholesalers cancel trades. The metal exists, but it is locked in vaults, inaccessible. You have cash in your hand, but cash cannot buy the asset you want most. This isn't scarcity in the usual sense. This is a liquidity nightmare. Here's what's happening behind the curtain. The silver market is a house of cards built on hedging, leverage, and trust. A refinery buys raw ore from a mine. It takes time to refine. In normal times, the refinery hedges in the futures market, selling paper silver equivalent to the physical metal it holds, so it can stay delta neutral. This protects the refinery against price swings while earning its refining fee. But the market isn't normal. At $6.30, demand exploded faster than the supply chain can handle. The hedging system, the very mechanism that allows refineries to function, collapsed. Margin calls hit. Refineries are solvent but illiquid. They stop buying ore. They stop producing bars. Wholesalers can't source metal and cancel orders. Retail investors like you are left holding nothing. Call it the refiner's trap. You may think $6.30 is cheap enough to buy all the silver you want. You would be wrong, because if you buy at $6.30 and tomorrow it rises to $8 or $10, you cannot restock. Your cash loses purchasing power. The system punishes early buyers with scarcity, not price. This is why the $6.30 price is meaningless. It is the last coordinate before the supply chain went dark. Even the legal side is working against you. Force majeure clauses, baked into bullion contracts and futures exchanges, allow companies to walk away when performance becomes impossible. With halted refineries and frozen deliveries, any dealer or bank can declare force majeure. They are legally allowed to settle your contract in cash at yesterday's price, leaving you with less than your share of physical silver and a massive loss if the market surges. And make no mistake, industrial buyers aren't waiting. Companies like Tesla, Samsung, and First Solar aren't chasing paper. They are stockpiling physical silver. They bypass wholesalers and refineries, paying premiums that retail investors can't touch. This creates what engineers call unobtainium dynamics, vertical price walls, inelastic demand, and panic buying. The industrial need for silver doesn't pause for price. It doubles down, driving scarcity even while the ticker shows $6.30. This is the first reality of the market. The paper price is a ghost. It no longer reflects what you can actually buy. Spot $6.30 exists on screens, but the physical market trades at $8, $9, even $10 per ounce in extreme cases. You think you're watching a pullback. You're watching a mirage. The divergence between paper and physical is called backwardation. Immediate possession is more valuable than promises for tomorrow, and trust has evaporated. Dealers, refineries, and investors no longer trust each other. Welcome to the era of unobtainium. The second reality is the industrial pivot. When refineries freeze, miners suddenly become the strategic reserve. The ore sits untouched in the ground, and suddenly the miners are the only source of supply. Industrial giants don't wait for paper prices to catch up. They go directly to the mines. They buy stakes, they finance production, they secure deliveries at any cost. The market is rewriting itself in real time. Miners who hold unhedged production, those who haven't sold their output forward at fixed prices, become the new gold standard. They have leverage, and the market knows it. But not all miners are created equal. Jurisdictional risks matter. Mexico, Peru, other large producers. Nationalization and windfall taxes are threats. Safe jurisdictions like Canada, Australia, and the US trade at a premium because their output can be reliably accessed. Savvy investors are moving from dealers with no stock to mining equities with real physical leverage. This is where the next phase of wealth accumulation lies. And yet, don't mistake this for calm. The old powers, the banks, the exchanges, the regulators, aren't passive. They can't conjure silver out of thin air, but they can create chaos to slow momentum. Expect margin hikes, position limits, regulatory threats, and ETF manipulations. These moves hurt paper demand, scare the uninformed, and create volatility. But here's the key. They cannot fix the fundamental shortage of physical silver. The roadmap to higher prices is already forming. First, a gamma squeeze pushes prices up, as market makers are forced to buy futures to hedge sold options. The price moves from $6.30 to $7.50 rapidly, driven not by speculation, but by mechanics of the market. Second, public mania sets in. When silver hits the headlines, the uninformed herd floods the market. Pawn shops, ETFs, and retail buying accelerate the move from $7.50 to $8.50. Third, industrial panic takes over. Corporations realize the price isn't coming back down, and they start hoarding at any cost. Bonds are issued, stakes are bought, production is secured, pushing the price to the true physical value, $10 or beyond. Corrections will happen along the way. Expect 10 to 20% pullbacks, moments of terror where the media declares the bubble has burst. Ignore them. The trajectory is locked by physical deficit, not sentiment. Industrial demand and scarcity determine the final outcome. So what do? You don't sell for cash. Selling at $10 when the system is failing means trading the scarcest asset for a currency losing value. The smart play is to swap, not sell. Trade silver for gold when the ratio favors it. Trade silver for land, businesses, or productive assets. This is how you lock in purchasing power without succumbing to fiat volatility. For example, imagine the gold to silver ratio drops below 30. 30 ounces of silver now buys 1 ounce of gold. Swapping silver for gold multiplies your wealth while avoiding exposure to collapsing dollars. Or consider real assets. A house or rental property can be bought for silver, not cash. At $6.30, the ratio is still skewed in your favor. But as the market approaches its unobtainium phase, these swaps become the safest way to preserve value. Meanwhile, the world is watching this wealth transfer unfold. Dealers with no inventory are losing out. Industrial buyers are hoarding. Miners are reaping enormous profits. And the price is being discovered in the physical market, not on a screen. If you've been stacking for years, you are on the right side. If you're waiting for a pullback, you might find yourself empty-handed. This is the reality. The $6.30 price is a trap, not an opportunity. It lulls you into thinking silver is cheap while the system collapses around you. Refineries halted, wholesalers canceled orders, force majeure clauses loom, industrial demand is inelastic. The only way to secure wealth is to understand the system, think ahead, and act strategically. And that brings us to the final, most dangerous phase, the regulatory hammer. Governments will try to intervene, margin hikes will push retail traders out, position limits will cap what you can own, tax threats and ETF manipulations will create panic. Headlines will scream, "The silver bubble has burst." But these measures don't create silver, they only increase scarcity. When the hammer drops, see it as a sign of desperation, not power. The market will continue to rise, driven by physical deficit and industrial necessity. Regulations cannot manufacture ounces. Taxes cannot conjure bars. ETFs cannot produce metal. The trajectory remains upward. The paper price is irrelevant. Now, let's talk about the final phase, the unobtainium explosion. At this point, silver becomes virtually impossible to get at any price. Industrial buyers bypass all intermediaries. Tech companies, auto manufacturers, and solar giants go directly to mines, financing production and locking up output. They pay premiums that retail investors can't match. The price is no longer negotiable. It isn't set by the screen. It is dictated by immediate possession and industrial necessity. This is the moment when fear of dying out, FODO, trumps fear of missing out, FOMO. By now, the market is fully divorced. The paper price might linger at $6.30, while physical trades at $10 or higher. Backwardation becomes extreme. Immediate delivery commands a premium because trust is gone. Nobody believes promises anymore. Dealers, refineries, and even ETFs cannot guarantee metal in hand. The market has entered a true scarcity phase. This is where the miners become the lifeboat. Apex Silver, a hypothetical unhedged miner, produces at $2 per ounce. The price is $6.30, giving them $4.30 free cash flow per ounce, a massive profit. Hedge their production, and they miss the rally. Leave it unhedged, and they become a magnet for industrial buyers and sovereign funds. Expect a wave of acquisitions, tech companies, auto giants, and sovereign wealth funds buying stakes to secure output. Mining stocks will explode, creating a supercycle in equities. But be selective. Not all miners benefit. Those locked into forward contracts at lower prices are excluded. Jurisdiction matters. Safe jurisdictions like Canada, the US, and Australia carry premiums because they can guarantee output. Mexico, Peru, and other large producers risk windfall taxes or nationalization. The next leg of wealth is where physical leverage meets jurisdictional safety. This is the game for strategic investors. Now, let's address the regulators. The empire striking back. Banks and governments lost the market war. They cannot create silver, but they can attempt a regulatory war. Margin nukes, position limits, windfall taxes, and ETF manipulation. Margin requirements could spike, forcing retail traders to liquidate. Position limits will cap exposure. Politicians will accuse hoarders of blocking green energy or committing price gouging. ETFs might suspend creation of new baskets, disconnecting from the physical market. Headlines will scream, "The bubble has burst." Don't panic. None of these actions solve the shortage. They only punish paper demand. Physical scarcity continues unabated. So, how does silver reach its true value? The path is predictable. Stage 1, gamma squeeze from $6.30 to $7.50. Options, hedging forces market makers to buy futures, creating a self-reinforcing loop. Stage 2, public mania, $7.50 to $8.50. Media attention brings uninformed investors rushing in. Pawn shops, ETFs, and retail buying explode. Stage 3, industrial panic, $8.50 to $10. Corporations recognize the permanent shortage, stop fighting the price, and hoard aggressively. Bonds are issued. Mines are purchased. Every ounce becomes strategic. The final target is psychological. Round numbers, $10 and beyond, where the paradigm shifts. During this climb, expect volatility, 10 to 20% pullbacks. Headlines screaming collapse, days of terror. Ignore them. The trajectory is governed by physical deficit and industrial necessity, not by paper speculation or media hysteria. This is the reality of unobtainium. Scarcity creates inelastic demand. Panic buying drives prices beyond what rational traders expect. The final question, what do you do when silver reaches $10? You don't sell for cash. Dollars are failing. Selling silver now is exchanging scarce wealth for collapsing currency. Instead, swap for assets that hold value. Gold, land, businesses, or productive investments. Gold swap. If the gold to silver ratio falls below 30, trade silver for gold to multiply wealth without returning to fiat. Asset swap. Trade silver for real estate, a rental property, or a business to lock in tangible value. These are your safe havens. This is the lesson. $6.30 is a trap. The market is broken. Refineries halted. Wholesalers canceled. Force majeure looms. Industrial demand is inelastic. The paper price is a ghost. Only physical possession matters. Only strategic swaps preserve wealth. For those who prepared early, listened at $2, $3, or $4, you are your own central bank. You have insurance against the collapse. For those waiting on the sidelines, the window is closed. You might find a few ounces at random, but the era of easy silver is over. We have entered the era of unobtainium. The bank's lost. The industry is panic buying. The price is seeking its true level. Hold your stack. Protect your assets. Watch the market evolve. This is the greatest wealth transfer in human history, and you are on the right side if you acted early. Remember, silver is not a ticker. It is physical, tangible wealth. It is scarcity, leverage, and survival. Treat it as such. $6.30 is the starting point, but the journey is defined by reality, not speculation. Strategy, insight, and physical possession will determine who thrives and who is left empty-handed. Hold the line. Protect your wealth. The show has just begun.